The wealthy people didn't get there by using these exclusive tricks. They got there by building a business, by saving, by being diligent, and by investing wisely, but not necessarily in a sophisticated way.
Welcome to Doc Street Advisors. Each week we ask a question of one of our advisors. This week we're joined by Spencer Ogden, where he's going to help us understand a little bit more about what he means when he says, don't invest like the wealthy. Let's get started. All right, Spencer, thanks for talking with me today.
Glad to be here.
We were talking the other day and you said that you shouldn't invest like the rich. They're doing it poorly. What did you mean by that?
Yeah, well, Groucho Marx had a line about I refuse to be a member of a club that would have me as a member. And I think that's a similar approach to joining the wealthy investor club. What do I mean by the wealthy investor club? You'll see a lot of YouTube videos or you'll see articles or things like you should do this because the wealthy are doing it, or you have access to something now that you have a certain amount of wealth. And so naturally, when we have access to something new, we're like, well, that sounds interesting. Maybe I should be doing that, especially when it's held up as, well, the wealthy are doing this. So if you want to get wealthier, you should do it too. So what are some more specific examples of this? Trusts are one example where I've seen YouTube videos that say every person in America should have a trust, or you want to be wealthy, a trust is your foundation. So before you start to build wealth, get your foundation in place, get a trust in place. Why I use that as an example is because trusts have their place. They have certain protections and controls that you can put in place, but they're not necessary to build wealth. They're not the first step. They are the step when you need that tool, you can add it to your situation. But there's no reason to put all that complication in before you're ready for it. It's like building a foundation for a skyscraper when you're starting out with a one-family home. You're overbuilding, you're overcomplicating the situation. Another example would be private investments. This is a term you hear called an accredited investor. That's when you reach a certain level of net worth or a certain level of income per year, which, are a couple $100,000 of income a year, $1 million or $2 million in assets. You become an accredited investor, which sounds like a great honor and, another club that you can join. Once you're of that status, you can invest in private funds. These are things like hedge funds, private equity, venture capital. There's any number of groups that will help you with that. You can go directly to some of these funds, or you can go through a platform like a large bank or a fund of hedge funds. I was in the hedge fund world for 14 years, so I've seen how the sausage gets made in that world and have a lot of exposure to the alternatives world. I have my Kaya, which is a chartered alternative investment analyst. So I've spent a lot of time looking at that side of the world. So this is another example where it feels interesting because, oh, this is something I didn't have access to before. The wealthy have access to this. The endowments like Yale and Harvard are doing this stuff. So this must be something really interesting. It's an exclusive thing that now that I have access to it, why wouldn't I do it? Well, the answer is that unless you're very dedicated in doing your research, there are thousands of funds and opportunities out there, only a very few of which actually have interesting returns. And mostly that's because the fee structures are very complicated and very opaque in most cases. Generally, you're talking something like 2 and 20, meaning 2% of the assets per year and 20% of the profits that are made. And again, that can make sense in certain contexts, but unless you have the skill to know which of these funds might live up to their promises, a whole lot of complication, not to mention the tax complications of getting invested in a private fund. It's not like you can take your money out whenever you want. All of these things have gates and lockups. You have to commit to them for multiple years. And at the end of the day, when you compare those after fee returns to what you could be doing in the public markets, meaning investing in the S&P, doing something simple, keeping it in ETFs, mutual funds, anything that's relatively simple, the extra return isn't as much as you might think. So another example of, what the wealthy might do that might not be as exciting as it sounds at first.
So say I want to be in this wealthy party group or in this exclusive club, but I don't follow the path that they're taking. You're saying not to do the things that they're doing. What are some of the things I should be doing?
Yeah, well, we would advocate an approach of focusing on what has worked through history and what is very clear and we can understand. Buffett always had a line of don't own anything that you don't understand, whether that's a business or a type of investment. And so we keep coming back to the public markets, US companies, international companies, simple bonds, whether that's what are called investment grade bonds of very strong companies or
Mm-hmm.
it's US Treasury bonds that are from the federal government. These are very clear things that we've got 100 years worth of data on, and we know how they work. When you buy a share of a company, we know what you're getting. We know which company it is. We know who's in charge. We know we can get the money out tomorrow by selling the stock. There's no extra fee. It's very clear what you're getting. Still requires research and still requires some analysis to do the
Mm-hmm.
right thing, but you've reduced the layers between you and your investment. Every
Mm-hmm.
time you do something, whether it's a trust between you and your assets, or it's a private fund between you and your assets, at some point your money is going from you into an account, into an investment, but maybe also through a fund, maybe also through a trust, and then finally
Right.
to the company that's actually doing something interesting with your money.
Yeah.
So reducing the length of that chain reduces a lot of the complication and uncertainty.
Mm-hmm. It sounds like there's a bit of a strain between something that ties into that exclusivity, that maybe feeling that people have of, well, this person must know more than I do. It's complicated, therefore it's better. But you're saying simplicity actually has immense benefits to a lot of investors.
Yeah, absolutely. And yeah, there's plenty of things out there that are marketed based on their sophistication or exclusivity. Another
Uh-huh.
example would be private banks. Sounds
Mm-hmm.
very exclusive, like a private country club, and no one really knows from the outside what it is. You need
Yeah.
$10 million of assets to get access to the private bank. So it seems like if you get to that level, of course you want access to the private bank. But what these really are is a focus group within a large institution that
Mm.
has the ability to what they call cross sell to you. What they'll
Yeah.
describe to a client as bringing you opportunities is cross selling different products that they have, meaning you become a private bank client, and the upside is now you've got one person you can talk to about all your banking needs, transferring money, and what's going on with your account. The
Mm-hmm.
flip side is that they come to you with an investment opportunity where they are charging fees on that. And maybe that's not exactly clear. Again, going back to how many layers are there. We've seen proposals from private banks where there's 6 pages of fee disclosures attached to the
Yeah.
proposal in terms of figuring out what are you actually paying for this opportunity that they're bringing to you. So private banks have the ability to bring estate planning to you, private funds, sophisticated investment strategies. But all
Mm-hmm.
these things come from a place of some conflict because the banks have an interest in having you work with them in a certain way, invest in certain products.
Yeah. Okay. Well, if you had one piece of advice for people kind of coming out of this conversation, what would you tell them to do today?
Don't join the Invest Like the Wealthy Club, and keep it simple. By and large, the wealthy people didn't get there by using these exclusive tricks. They got there by building a business, by saving, by being diligent, and by investing wisely, but not necessarily in a sophisticated way.
Great. Well, thanks, Spencer. I really appreciate it.
Yeah, thanks.
Well, thank you to Spencer for taking the time with us today. I hope this helped a few of you out there. If you have any questions, feel free to leave them in the comments or email us at the address in our bio. But come back next week as we'll have another question for one of our advisors as we continue to demystify the world of investing.